Good morning. We're here today with the CEO of Domino's Pizza Enterprises, Don Meij. Don, thanks for your time.
Thank you, Joe.
A few questions for Don this morning. Starting off, Don, for a new investor looking at the Domino's Pizza share price and thinking, I've missed this journey, can you just remind us of the future growth and the leverage within your key markets?
Yeah, I think the things that new investors may not appreciate so much about Domino's Pizza Enterprises is that whilst we are doing these acquisitions, and they do come along and we intend to do more, it's the ability to leverage what we're doing that's showing the scale and growth of earnings. So, in this last half when we grew 57%, well, that's because of the work we'd done leading into that year, and it was all organic growth in that year. So that's why it was so accretive, the EPS, jumping up around that 50% number as well, because of all of the organic work we're doing in the business. So when we think of our growth, we think that the reason we can deliver strong compounding growth ongoing is that, one, we are opening a lot of stores, because we're in territories where we need a lot more stores. Even Australia, New Zealand, which is our oldest market, we still have over 200 stores to open right now. So that's great scale and leverage on an infrastructure which is basically built. The second thing is that we're creating new and disruptive technologies that are ongoing, and we don't have a short pipeline of that. The way we've worked our model, it's not like we're bulletproof. Things can of course go wrong because there can be outside influences on what we do, but by and large, we've got a really good pipeline of things that we know can deliver growth. Now, those things 6% growth or those things 14% growth like we just showed in a like-for-like basis, but either one of those numbers plus store count growth deliver a strong network sales growth, which deliver strong earnings, more flow through to the bottom line. So that's the second big reason why we've got stores to open, we've got really strong organic plans, we are a disruptive player with very entrenched views of short-term and long-term projects we're working on. The third thing that happens in our business is we're a franchise business. So franchising doesn't require a lot of capital in the operating of the stores. So therefore, a lot of it does flow straight through to the bottom line. If we're using capital, it's often in innovation, and that innovation capital comes back to us over 3 or 4 years because we charge it back into the system, into the advertising funds. These are advertising tools. There is some OPEX we write off. We do have a margin in what we do to cover that and a little bit more. But that's another reason why so much of the growth is leveraged and flows through to the bottom line. And then the fourth factor is a bonus factor in that everything is a profit center in our business, and so whether it's One Digital, which is our disruptive software developing department, whether it's our equipment business, whether it's our printing, point of sale, digital marketing business. Now these businesses also sell often to outside services. And there's incomes that come in from that as well. So that's why we're getting leverage there as well. So if you're an outside investor, you've really got to get your head around all of these moving pieces and how they're connecting. And we try to model a business that we should be able to deliver as a minimum 20% compounding growth. And then when everything comes together, this year we're forecasting 35 now. Last year we delivered 42. So the power of compounding numbers means that it doesn't take long for the valuation to reduce pretty quickly. That's the model that we're working.
And digital innovation and technology, a really key part of your success over the years, and I expect will continue. Can you just give us a bit of a feel how excited you are in the pipeline the year ahead and any further game changes we can look forward to?
Yeah, so there's projects we're working on now that are 3 years out. There's projects that we're working on that will be delivered in 3 months, and there's projects that are going to be all of next year. So we already have the whole pipeline for next year. And when I look at those, I know they'll be successful launches. What I don't know is the depth of success. So success could be a 6% or it could be a 12 or 14 or who knows. And I know that as long as I can get that 4 to 6, which is our long-term guidance, as long as I can get compounding 4 to 6 and open a strong number of stores, then we will deliver the prospects. So we are very developed on these concepts. They're not, we might do something, they're being built, including a 3-year project from now is currently in development. Now, some of them may not make it, but there is a pipeline of things always coming through behind that. And that's Australia and New Zealand. Europe and Japan have the pipeline of things we've already developed and proven to be successful and launched in Australia. So if we look at the Netherlands is the next most developed digital business. In fact, it has higher online sales than Australia. And yet it doesn't have Pizza Mogul, it doesn't have GPS driver tracker yet, it doesn't have guarantees yet, it doesn't have SMS ordering yet. These are all being proven success stories. So the most successful market out of Australia, in fact, does more online sales, still has things that we've launched in Australia to be successful, and then we've got all these other things we're about to launch, which will either be that 6 to 10, 12, whatever %. What an amazing pipeline for those businesses. So when you consider that Europe is going to become a much bigger business than Australia, and there's all this pipeline of stuff, if for some reason something didn't work in Australia, well, Europe can just remove that from the program and still has enough pipeline of things to roll. So we'd have to screw up in Australia for about 18 months to 2 years for the rest of the countries to then end up in trouble as well. So
basically it's never looked better.
It hasn't looked better at the moment. What are the risks? Management has to stay focused. You can't just assume. We need to continue to develop the quality of people we've developed, because the execution still relies on the talent. We've had a good track record of that, but you can't take that for granted. It keeps me up at night all the time of, is this person being groomed and looked after because they're a potential superstar? Are we putting so much time over here when maybe that isn't, that person or that team isn't showing the influence that they could? So it's not a walk in the park, but it's up for us to screw up, basically, because the opportunity's there, and it's tangible opportunity, and it's just a matter of the people, the team, my team and I delivering it ongoing.
And lastly, Don, obviously so much organic growth on offer here, but the obvious question, and you've been so good at executing acquisitions and bringing, exporting the domestic model offshore. Can we look forward to any acquisitions in the future?
The answer is yes. We will. We are active. We'll continue to be active. I can say this year we're really busy. I mean, Andrew needs a lot of support. Germany's happening very quickly for us. Sprint's happening well. The first store already converted with Sprint, so that's really exciting. So he needs some of the Australian team over there supporting him right now, as well as his team is fully committed. So we need to move to that, and I think we'll be out of that by Christmas. And then you look up and say, okay, these other things we've been working on in the background, can we start bringing them to life or not? So yeah, we're still active in that space. We're not dependent on that though. That's all continues to be bonus work. What Germany and Sprint will contribute to the business in the next 12 months is still relatively small on the scale of earnings that are coming from Australia, New Zealand, Japan, France, Netherlands, Belgium. Those alone, standalone, produce really great results. Germany and Sprint coming on are bonuses, and any future acquisition we look at as more bonus work, because the law of compounding numbers is, this year, when you look at the size and scale of earnings, what we believe we can do next year, these things that are coming on are still relatively small. They're big earnings if you're a standalone Australian company, but with everything we've got going, it's what they'll do after that. And then they also come on big, like Japan's come on big, like finally Europe's come on big. So shareholders don't need to depend on those to hit the kind of growth we're forecasting. It's just additional.
Okay, so there you have it, Domino's Pizza, the growth's far from over here. We're on track to get 35% EPS growth this year, and if management's track record's anything to go by, there should be some upside to that as well. And FY17 shaping up to be an even stronger year from the growth, with key digital platforms to be rolled out into more global markets. Dom, thanks for your time.
Thanks, Joe.